everyone, and welcome to another episode of XVC Tech Insights, where we get top tier VCs, successful founders, and innovative projects come to our podcast and talk everything about Web3 and give you the top tier advice that you would benefit from. I'm Aneri Merchant, investment manager at XVC Tech. XVC Tech is a $125 million Web3 VC arm of the XDC Layer 1 EVM compatible blockchain. Today, I have with me Pranav, who is the head of investments at Foundership. Welcome, Pranav, to our XVC Tech podcast. It's a pleasure to host you today.
Pleasure is all mine, Aneri. Thank you for having me and look forward to our conversation.
So, before we start talking about what Foundership does, let's talk briefly about who exactly is Pranav Agrawal? What has your career been till date? And what actually got you into the world of Web3?
Yeah, absolutely. I think it's a very unique journey that I've been through to get to where I am today. Uh, I did my MBA from India and then worked for SR, which is one of India's largest MNCs across the mining metal space. This was mainly India, Indonesia, Africa, America. So it was a 15-year career where I left as the CFO of their mining business in the US. And through this journey, I've done over $1 billion of fundraising, M&A, Chapter 11 restructuring, and all of that. So I was always interested in the investing side of things. But through 2015-16, I began looking at crypto, Web3, as the Web3 space evolved with Ethereum and all the other L1s taking birth and the adoption. One thing led to another. Post COVID, did a deep dive on what this tech is, and I think it's going to be the future uh, infra layer for a lot of the assets to be built on or assets to be ledgerized. And therefore, I just felt that it's so early. Let's go in and let's take some TradFi playbooks to the Web3 world. And that's why I chose to do investing in Web3, and Foundership was the perfect home for that.
So, Pranav, you are like one of the most well known faces in the UAE, probably speaking at most of the events, attending events, and everyone just knows about you, right? So, in a very short span of time, you've achieved a very good name for yourself within the MENA region. So, you started off with Foundership, which is a Web3 accelerator, and XDC is also associated with Foundership. So let's talk briefly about what the Foundership Accelerator is all about. What got you into the idea of starting this out, and what is your future journey in terms of the Foundership Accelerator?
Absolutely. I think Santosh and Bimlesh are founders, and I know Santosh for a long time since he was building his previous startup called Explara. One thing led to another, and it was like, hey, why don't you come in and help us set up the investments arm? Because we wanted to be Y Combinator for Web3 and emerging tech. Web3 was super hot. This is around 2022. So we were looking at, basically providing coaching community capital to our startups. We wanted to be global from day one. In the last 3 years, happy to say that we've got 55 startups from 15 countries. Our top 10 are worth over $300 million as per their latest valuations. And that's just given us the confidence and the comfort and the ability to help our startups from zero to one. And in an industry that's changing, I would say every quarter, where we have a flavor of the month every month, it's just helpful that we are there navigating with the founders through their zero to one journey, helping them do whatever is the most priority aspect or most priority key point for them. And going forward, we want to be a full-fledged accelerator VC, very similar to Y Combinator. We've got a couple of funds, one in the Web3 space, one in the AI space that we're setting up. And both our themes are horizontal. So we are not vertically restricted, but Web3 AI are both horizontal themes, which could work across geographies, across verticals, industries, domains, different value points in an industry. And therefore, we're just looking at two horizontal themes to build out foundership and our portfolio over the next 10 years.
I can completely vouch for Foundership and the kind of quality of mentorship that they get to the projects because we've done two accelerators together and I hear everything nice and everything positive from all the founders who have completed or are currently going through the program. So I can 100% vouch for the quality that Foundership gets to the table. Now, since we are talking about the accelerator, a natural progression would be once the project graduates, we go to the VCs, right? And the VC investing has gone a significant change over the years, and Web3 as an industry moves at a lightning speed. It's crazy with how things happen, the narratives change. So in this industry, how should a VC have their investment thesis? In this environment, should they have a natural thesis, or should it be that their thesis should evolve as per the narratives of Web3? What is your take on this?
So I always like to say that crypto never sleeps. If we are an industry that has a 24/7 global presence, and therefore when I'm investing in this space, we have to think of something that is changing at the speed of light, like you rightly said. So the thesis is more in terms of what are your timelines and what are your return expectations. If you're looking at token investments with a 2 to 4 year cycle that we've typically seen in the last 15 years, then those define my thesis, because it'll have to be themes that are more current and more in the news. But for us, we've looked at more from an innovation and pushing boundaries perspective. So we want to do things which otherwise would seem very, very out of this world or low probability, but that's the advantage of an accelerator VC, right? So we've got startups who are building in tokenized hotel rooms, tokenized publishing houses, tokenized movie credits, tokenized movie IP, tokenized and all sorts of assets on chain, bringing all sorts of assets on chain. We've got a lot of payments and stablecoins related startups that are doing debit cards where you can spend your crypto, credit cards where you can borrow on crypto, and all sorts of DeFi products. So games which are bringing tokenized rewards, tokenized betting, tokenized skill based gaming to the market. So I think for us, we wanted to focus on something that was maybe more lower probability but longer term on the adoption curve. And our thesis is always being founder first, where we have founders who don't give up. So as long as our founders don't give up, we believe that they'll find a way.
Right. So in Web3, there are multiple types of VCs. So from what I assume, that foundership adopts a very sector agnostic approach. But for say a strategic VC such as XVC Tech, wherein we invest in projects which are a part of the XVC ecosystem, versus a traditional fund, how should their thesis be defined? Is there any right or wrong, any black and white approach, or is it something that probably, if it's the DeFi summer coming, or if it's the gaming narrative that's going to take place in a couple of months, you shift to that? But like you said, the token has 2 years, 3 years vesting. So by the time you vest all your tokens, the narratives definitely
Yes.
changed. So how should these traditional funds as well as strategic funds define their thesis?
So I think when it comes to a large corporate VC like yourselves with a fairly large book, much bigger than what we would have even going forward, it's a very different approach. Ours is more nimble, more flexible, and because we're doing investments as waves of cohorts, it allows us the ability to look at the narratives that are hot and happening. I think for corporate VCs, it's very important that they have projects that are strategically aligned and are looking at scalable products. So, like we've done, like I know XVC has done Circle of Games, which is also one of Foundership's portfolio companies. They've already got over 500,000 downloads. They have around 100,000 MAU users. So, those are the kind of products which help bring visibility, more users, higher number of transactions, more XDC tokens in people's wallets, right? And we've always seen that crypto is a game of mind share. So if even one DApp that gives you mind share in a crypto user or a crypto uh, token holder's mind, then that's a win in my books, right? So that's the idea. And what you need to do is also probably look at how you can sort of collaborate versus, and sort of intermingle products that can then help each other acquire users, better retention, better D30, day 60, day 90 user retention. So those sort of strategic. Plus, I also think you have to invest in tooling. So one thing I always tell all our chain partners, including you, I know we've had this conversation so many times, is that if we have to attract the best founders in crypto, we have to provide them with the best tooling other than a great chain, right? I agree, XDC is a great chain, super low cost, super reliable, very, very focused on ensuring uptime, security, etc. But at the same time, they need to have the right tooling set, whether it's go-to-market strategies, whether it's launch pads, whether it's exchanges, DEXs, ICO, IDO platforms. So we need to have the right tooling, market maker relationships for them to be able to grow their own token business, because their own token market caps will determine the success of their businesses and thereby success of XDC and XVC's investments.
Right. So, this is a very interesting perspective you gave on how a corporate VC such as ours should actually define our investment thesis. Now, let's assume we have defined our investment thesis. The next challenge comes in lead generation, right? Because Web3 is very decentralized, very scattered. I would say quite a few scammy people as well. Yeah. So, how would you generate leads? Is it something that you would probably scan Twitter threads? You would jump into Discord channels to see what kind of conversation is going on, to see what actually are the real users as compared to bots? Or would you just rely on your fellow VCs and your friendly builders with whom you have good relations to give you those leads? What's the right way to source good quality top projects on the chain?
So I think for a ecosystem fund like yourself, we can't have a push approach. I can't push people to build on XDC because that's not sustainable. They might get incentivized in the short term, but they'll never think of us as the long term destination where they will grow. What we need is to build an attraction which pulls and attracts the best founders in the industry. Some of the things which are always very attractive from my founder experience, having spoken to about, I speak to about 10 founders a week. So my in my experience, founders love the fact that there is capital available. That becomes a very interesting honeypot for the founders. But we all know that capital is just the starting point, not the end point. The second is the tooling. The third is the community. And the fourth is actually the support from the chain itself in terms of it's one of the USPs of foundership has been that we've been able to build a relationship and build a bridge with at least 2 dozen chains globally, and our founders love and respect that. So we've seen that when chains, and especially you've played personally a huge role for us, where any project that wants to build on XDC or is building on XDC, we've had the privilege of reaching out to you and you've always responded within a 1 day TAT, right? So that gives us a lot of comfort and confidence when we're recommending XDC to somebody. So that I feel this is the whole set of factors which become a pull for great founders to come. And then certain things like market determined, which we can't really control, are one or two success stories. So the moment we have one or two success stories, which we hope to have from our cohort very soon, and those will then further attract 10x, 100x more founders.
So, would it be safe to say that for a VC, it's always warm intros which probably work much better than probably us reaching out to projects, say through networking events? Because the number of networking events is endless in Web3. You could probably have a full-time job just attending events, even in Dubai, right? So, we are always in search of good projects, but at some point of time, you do need a reference check, either from their prior investors or their partners, to really understand whether this project is worth our time and effort and money as well.
100%. I think warm intros are one of the now open secrets of the industry, where most investors, whether private, angel, or institutional VCs, would definitely give a lot more attention to a warm intro lead than to a cold lead which you meet in a networking event, or a cold inbound either through LinkedIn or email or Twitter or X. And I think warm intros is where we also, as an accelerator, have been able to help more than 25 of our startups raise follow on capital. And I'm sure you guys have also invested in a lot of your investments are actually warm intros in the first place.
Because that helps as a first filter, and you do get some kind of confidence when it comes through a known source.
Totally. And the credibility of the source is also at question, right? So if it's a warm intro from a known source who's known to be cautious, isn't spraying and praying. So what I don't define as a warm intro is somebody who wants to help you in fundraising and then makes 200 Telegram and groups, or shares you 150 emails and just shares the blurb on all of them and expects that 5 of them reach out, right? So I think that is a very bad example or way to run warm intros. The warm intros are specifically curated, knowing what the other investor is looking for, knowing what the project has as a value add, and then stating that to the other side when they're making the introduction.
And it's a part of the relationship building as well, because that's something that's very important in Web3. So, what's your take on VCs going on as a lead investor versus being a part of the syndicate? What do you think works better in Web3? Do you think the traditional model of, say, having a minority stake, but a significant minority stake, 15 to 18%, works well in Web3, or should we like just be happy with 2 3%? What's your take on this?
So one of the very important structural differences between Web3 and Web2 investments or TradFi technology investments is that there is no dilution, right? So when we have a token allocation at, say, 2% at 20 million, right? Somebody puts a 400K check, gets 2% at 20 million. Their 2% doesn't get diluted no matter how much capital the founder raises after that, unless they completely change the deal terms. So the anti-dilution means that anything from 1 to 4% would be a great bet on a startup. I wouldn't increase beyond that because you wouldn't be able to exit. So even if you had a 2-year vesting and you waited entire 2 years to exit this investment and allowed the founder the opportunity to grow their business, at the end of 2 years, you'd take 2 more years to make a 4% exit, right? Because you can't sell more than certain percentage points in a particular month. So that will bring a continuous sell pressure on their token. So ideally, I would say 1 to 2.5% is like a sweet spot. Less than 1% doesn't make it meaningful, because if it's $100 million exit and you have a 1%, it's less than $1 million. So I think that is sort of where the sweet spot lies for the tier 2. And if it's a tier 1 deal, which is potentially a multi-billion-dollar token listing, then even a sub 1% to 0.5% is a great stake to have.
What's your thought on having like a hybrid structure? Because we are talking about a token deal right now, but let's be honest, not all tokens do well. So in that scenario, when a VC is really believes in the business model of the project, it's pretty separate from what the token price is. So in that case, should they focus on having a hybrid structure such as a safe plus token warrant, or do you still think that the token model itself works better?
The safe is, or an equity play or equity exposure is great if there's a product that has a long-term revenue path, EBITDA path, and therefore potentially an M&A, right? Because I wouldn't think an IPO is really on the cards for a token project, but an M&A is definitely happening and possible. And we're seeing a lot of M&A now in the last 12 months in the industry, especially even with listed tokens in the $10 to $25 million FDMC range, where they've been acquired for about $5-10 million, giving an equity exit as well as a token exits. So I think definitely, and coming back to your previous point on lead investor, I think it ties into that part. If somebody has the ability to do a technology diligence, like at Foundership, we don't believe we are great tech experts to be able to evaluate a technology build. But if somebody has the ability to to evaluate a tech, then they should be lead investors, and by all means have that equity play, because they also have then rights to the business. If it's liquidated, tokens don't survive, or tokens don't get launched at all, they at least have a dip in the business to be able to use the technology, license the technology, merge the technology into some other of their startups where it's relevant down the value chain in the same supply chain. So I think that is super important for large VCs who have the ability to evaluate tech when they're going in, and they should definitely then lead the round and also set the valuation and round terms.
That would also help them being on board of directors, have voting power, and probably drive the narrative of the company as well in the long run.
Yeah, we've seen something very, I know we hate, it's like the underbelly of the industry with Gensol and Blue Smart in India recently, where a large amount of financial, I would say, misuse or abuse has been uncovered, both at a listed company and a Series D, post Series D startup. And that sort of has brought us to a very interesting point where investors are now looking at increasing their information rights, increasing their governance access, and building in more checks and balances. I think it slows down founders, but a post Series B founder has to have a clear path to profitability, if not already profitable, and therefore they shouldn't have a problem with the higher governance or information rights. And I would say someone recently told me, Pranav, that you should look at a venture debt like model. Like, think of yourself as a creditor and not an equity investor when you're looking at information rights. So, like, just like a bank will ask you everything about yourself, you should use that kind of an approach when you're looking at later stage investments after Series A or Series B.
So, term sheet, covenants, and due diligence is just going to get tougher. When you have these outliers in the industry, it kind of gives a setback to the VCs as well that, hey, let's just review what we are doing and let's just get those control checks in place to ensure the investments that we do are at least good from our side to go.
Yeah, absolutely. Because a lot of people always like to think that the VCs are the ones who are investing the money, but it's not, right? We're just allocators who are actually investing the money of the LPs. So we're only fiduciary in charge of. I believe we bring two skill sets to the table, right? One is diligence and one is access. So A, do you have access to great deal flow? And B, do you have the ability to then diligence that deal flow to identify the winners? And the money belongs to the LPs. The money, the responsibility of the VC is to ensure the safeguard the capital of the LPs. So we have to have the founders also need to be able to understand that where we are coming from is not from uh, I want to trouble you for more information, but more from a we are responsible for this capital we are promising you or have given you. Therefore, we are also entitled to, our LPs are also entitled to that information about your startup and they want to know what's going on.
Right, right. So now Web3 often exceeds traditional expectations, right? So we have an indicator called internal rate of return, which is actually a measure of risk to reward ratio. So the higher the risk, the higher the reward. Now, this probably doesn't work in Web3. Now, Web3 is already risky, but then again, the riskier class is the meme coins. Now, definitely there would be a few outliers which give majority of the returns. But do you think this IRR or the more traditional method work well in the Web3 space, or do you think it's more the Web2 traditional TradFi bit?
I am a I am a conservative guy when it comes to the way I run my investments personally or for the business. So therefore, I think IRR is the North Star metric when I'm talking to an investor, either as an LP or even for me personally as an angel. And therefore, uh, in terms of the risk reward spectrum, if you were to look at a macro, probably a US debt is what we call as risk free returns globally, T-bill, and on the right end of that spectrum is the alternates, which is what crypto falls under. And within the crypto spectrum, I think Bitcoin is probably the safest gold standard when it comes to investments within crypto, which, like you mentioned, meme coins being the other end of the spectrum on the higher risk. And therefore, for me, I think our cycles are shorter. We're looking at a sub 5 year cycle versus a above 5 year cycle when it comes to tech VC. Therefore, even a 25-30% IRR is a great IRR as a structured return. And what I have seen is that as crypto VCs, we often have to manufacture exits more. So it could be a combination of OTC deals we were talking about earlier today, where we try and get out of positions which have listed even at a 30, 40, 50% discount, but we don't, but we de-risk the tail end of the tail end risk, where if the market tanks and goes down 80%, which we've seen in every cycle, then it may not even get us the 50%. So bird in hand is worth two in the bush, right? And that's where I feel that we'll get a lot of IRR locked in, and returning the principal to the investor should be our first objective. I think that's like the primary goal for any VC who's deploying capital.
There is this infamous J curve, which basically says that the early returns of the funds are usually negative before the fund gives a parabolic return. Now, with Web3 moving so fast and the public tokens actually not performing that well in the longer run, apart from a few known tokens, how do you think this J curve actually defines the space within the Web3?
So that's a very interesting angle because I think if you're looking at a 3-year deployment period and like a 7-year fund, say 5 years from the third year is say Guruvar it takes 7 years, then by the time you have your third year, you would have started getting disbursements from your first checks, right? Or dividends or like sort of returns from your first checks. And that is why the J curve may not really apply to us. What we've been doing is, and what I've been following personally as an angel also, is exiting the first 50% of the unlocks as they unlock, with keeping the second half of my sort of token allocations as a moon bag, right? That in case this project announces something or does something really well and actually ends up hitting like a moonshot, and then I have 50% of my bag. So the intent is, I would say, 1x to return my principal is first priority. Once 1x is done, sell out the first half to lock in certain returns, because only when we lock in returns can we reinvest this capital, right? We can't lose the capital because then we are out of the business. So first half to sort of lock in the capital, and then the second half as a moon bag as and when. And one thing that has helped both personally me and foundership is we remain in very close touch with our founders. That also allows us to add value as they grow their business or build their business, but it also gives us insights into their business and what is the roadmap that they're currently focusing on, which allows us to take calls on when to exit and when to hold.
Right. So you come in more as a strategic investor, wherein you provide a lot of help in terms of connecting, say, mentors to projects, to integrations, or to blockchains, grants, investments. So that's how the curve would probably work in your favor, much better than a
Yes.
traditional financial investor.
Absolutely, absolutely. And because we're so early stage in terms of where we get in as an accelerator, we're looking at like a pre-seed, angel pre-seed kind of a round. So therefore, it allows us to also unlock better multiples where later stage investors may not have that same return. So, pre-TG investor may be at 2x, but we could be at 10x.
Right.
So that is also something which has helped us in the longer run.
Right. So now, since we are talking a lot about early stage projects, let's talk more about the metrics that define the KPI. Now, in traditional world, it would mean like higher revenue, better profitability, sustainability, more VC funding. But Web3 works differently. There is a token price and then there is a project. Now, apart from the token price, what would be your key metrics that you would evaluate to say that, yes, I have invested in a project that has become successful?
For us, we've looked at app usage or DApp usage. So we always like to say that your token is a separate product from your actual product, which is your business, right? So a founder cannot focus on one of the two. They have to be able to focus on both, which is a counterintuitive skill, or it feels like, hey, how much do I have to do? But that's exactly how you have to approach this business, where your product is still early stage, but you may have a live token in the market which has a 24/7 price ticker. So therefore, for us, in terms of the product, I think A is the product build itself, right? Are you going from MVP to alpha, beta? If you're mobile based, then are you having app store presence? Are you having Play Store presence? If you're web based, are you on as many PCs as you or browsers as you should be? With all of those, how much is your retention? How much is your user? Ultimately, we've not seen revenue metrics grow in Web3 apart from exchanges, which is either sexes or dexes, but other dApps are still struggling to find PMF or revenue. Therefore, we've not really used revenue as a metric yet. For us, having downloads, having visibility is a great way. Plus, if you're on a chain, we always like to promote the chain partners and say that these are one of your allies in this battle of growing this startup. So look at giving more transactions on chain. So how much can you grow the on chain aspect of your product? How much can you bring more wallet attention? more token holders, because only when you have actual Web3 users will your token price also have that catch. You'll have a upward spiral where the token holders and the users commingle. That's the ideal world where all my users are also my token investors. And Web3 is a very unique stage where is a very unique industry where your customers, your token holders, your investors, your employees, and your larger TG or your community are all available to you as one pool of people, which is very unique, right? It doesn't work like that. Like Apple shareholders and Apple users will have a very small subset. But when it comes to XDC users and XDC token holders, it will be a much larger subset. And that's a unique advantage. Founders should leverage that to grow both the sides, grow the users and grow the token holders.
Right. So Web3 is very unique and like you just mentioned, and it's still evolving. And founders themselves are also learning the tricks of the trade because, again, there is no black or white. It's pretty much a gray area on what works, what doesn't, depending on the cycle, depending on what product you're building. So, since you mentioned you speak to so many founders, like 10, 12 founders a week, what are the unique characteristics that you think define a successful founder? Do you have any kind of red flags that you look for, or do you have that intuition when you speak to a founder that tells you, yes, I believe in this guy. The project may not be that good, but I know he can navigate the rough waters.
Absolutely. I am a gut instinct investor. Uh, I've done investments personally as angels, all as angel checks also, where I love a founder, I love their passion, I love what they've done, but they're still an undergrad. And therefore, I know that this may not be their most successful startup, but I'm going to invest in their next three startups, knowing that one of these three is going to be a home run. So for me personally, I think founder never giving up is super important. I always tell every founder that you only lose the battle when you give up. Integrity is very, very, very crucial for me. I am okay with failing, right? Nobody, as an investor or a founder or a stakeholder, can mitigate failure risk. None of us can, whether it's our business, your business, we can't mitigate failure of business risk. What we can mitigate is integrity. If somebody is not having the integrity, we'll never succeed as an investor. So, my way to check integrity has always been, who do you know? Can I find a few common touch points who know you from longer than I know you? And that has helped me really well, because a lot of times I love a project, I love the pitch, I love the team, love the theme and narrative. Valuations are all right. But then I do three phone calls and I hear one of them say, think about it, Pranav. I don't know how his last startup was, but I think they had some issues. And that's enough of a indicator to me that, hey, something went wrong. I'll probably, knowing myself, I'll probably confront the founder saying like, hey, I heard something about your last startup. If they have a great explanation, that's great. I can verify that. But if not, then I'd rather not touch that.
Right. So these days, a lot of founders actually want to launch a token because they think it's a get rich scheme. But what we've noticed, like, from all the DD calls that we've done, not every project really requires a token. And a lot of founders actually push the token element in because, hey, it's a token launch accelerator, I'll get 100K. So let me just get the token in. Or probably, I will launch a token, I'll pump it up, my community will come, I'll raise money from launch pads and I'll exit, right? So it's probably an exit mechanism for the founders as well, or maybe get rich money scheme. So it's very difficult to actually understand who the real founder is, whether his passion is really into building the project. So how do you go on about telling the founder that, hey, you really don't need to launch a token at this point, or probably when you have to, this is the right time?
So I actually go one step even sort of higher, in the sense that uh, I like to tell founders, A, ask yourself if this is a venture backable business or not in the first place. Do you really need venture capital? Because venture capitalists are looking for a multiplier outcome. They don't want a 10-15% CAGR with an exit potential. What they're looking for is a 20-50x multiple exit, right? And therefore, is this business suited for venture capital? Otherwise, look for other patient capital which will want dividends, which will want increase in valuation, and will be with you for 10 years as a partner more than a investor. When it comes to, and if that threshold is passed, then comes the utility token aspect, where a utility token is very clearly more like, I always say, a loyalty program. So it's meant to reward your stakeholders. It's actually not a reward mechanism for the team and management. Wherever the team and management has put themselves first before the community and other stakeholders, they've also, it's like killing the golden egg, right? It's like killing the goose that lays the golden egg. So you're going to end up killing the goose and nobody ever makes any money. But if a founder and team go with a community first, community investor stakeholder approach, where they want to add value and build value for them, I've always seen that founders come out with maximum value for themselves as well.
I completely agree, because what we've seen even when we were reviewing a few tokenomics is that the founders have a massive unlock on TGE, right? So that actually beats the purpose, that if you really believe in your project, you should probably have a longer cliff and a vesting period and a smaller unlock at TGE, maybe to incentivize. So I completely agree with your point on that. Now, Web3, as it's evolving, even the funding, the way funding is dispersed is evolving. We are seeing a lot of DAO structures coming up. So, what is your take on the Web3 funding coming up in the future? Do you think there's going to be a massive shift in terms of how, say, corporate VCs or institutions or accelerators like yourself actually invest, or the structure of the investment?
So we've seen two very distinct structures. We've seen the traditional institutional LPGP funds or prop capital funds or family offices funds, which is crypto founders who've now built some wealth, become like family offices for Web3 investments, which is akin to our technology Web2 last 2 decades. But what's unique to Web3 has been the community funding. What I call community funding is everything from DAO-like structures to syndicate-like deals where ticket sizes could be as small as $1,000, $500. And we've also seen it play out in terms of the community launch pads, right? The launch pads that we're aware of, where tickets could be as small as $100, $200 even. And I think that is something which we will see grow. More and more token holders are realizing that if they can get in early, they have a cushion against the fall of the token price. And therefore, they're looking to, as they learn and evolve and want to keep doing newer projects, they want to keep entering earlier and earlier. And we're seeing a lot of the airdrop farming, engagement farming also result in a place where I won't reward you if you've not brought in some capital. It could be as TVL, it could be as transaction fees, it could be as something else, but it has to have real money participation from the users to be able to get a material reward back from the project. So I think the community DAO and the community funding is super critical. It will only grow, and especially as it is, the sweet spot is before TGE, but not too soon before, but not too soon in the product phase, right? So you're like post product, live product, pre TGE, which is where the community launch pads, etc., operate. Or just post TG, we're seeing some interesting products come out where communities can come and buy locked tokens for 2, 3, 6 months and participate with a discount to the current market price, therefore cushioning their entry as well as giving the project some much needed treasury liquidity after they've got a price from the market post TG.
Got it, right. So you see a new structure evolving more in terms of the community DAO structure as compared to the investment that is currently being held now.
Yeah, definitely. I think communities will keep investing. It'll be a way of retail to participate in pre TG.
And when they are incentivized, they have more the reason to invest, right?
Yeah, and it's just a math, right? Like at one level, if a project is raising capital at say 25 million pre-TGE, it does a 5x on TGE, it's at 150, 125 million, and then even has a 60-70% drawdown, there's still a 2x exit for the person who got in at 25 million, right? If they didn't get a chance to exit through the whole 150 and back. So that is, I think, the cushion which we build when we do early stage investing. And uh, it's much more mathematically probable that we get a 1x exit from there than it is from post TG pump projects where the prices are already high and it's a good time for us to exit.
Right. So we've spoken a lot about early stage, pre-seed, seed investing. Let's go on to say the crypto industry is maturing now, and a lot of deals are happening in the later stage worth billions of dollars. So I think the time has not yet come, but we are still moving towards a lot of consolidation phase in terms of mature projects, with a lot of M&A activities also happening, with big institutions buying out smaller projects for billions of dollars. So what is your take on that? When do you think the actual M&A, core M&A activity would start, and what kind of projects are more suited for these kind of M&A activities?
So we're seeing a lot of M&A already. M&A is working very well in two types of products. So I would say what we call as DeFi, where the moat or the early win has been a large TVL, a large user base, a very good secure product that didn't have a security incident. If somebody has a combination of this, especially with a token live in the market, which gives them a market valuation also, that has been a very interesting M&A angle. The other one we're seeing is non-token businesses which are in the regulated space. So very often I hear about or I receive inbounds about uh, family houses or investment houses looking to enter the UAE market with a VARA OTC broker dealer license. And that is something which is very rare. And I think the second type of M&A has been the one which is regulated, compliant, because that builds a moat around that business. But they may not have been able to raise users, raise more money, or onboard as many users as they liked. But their regulatory compliant framework is still valuable to somebody else who wants to come in with the distribution. So I think that is the second sort of, and maybe a third element is where you have like a high user base, no or low monetization opportunity. Like my favorite example for that is wallets. There are several wallets which have hundreds of thousands of downloads and MAUs, but they have no way to monetize because people generally don't swap on a wallet. If you're a power user or you're crypto native, you'll connect to the cheapest way to swap your tokens instead of doing it from the wallet interface. And therefore, we're seeing that they have very low monetization opportunity. It's not really a SaaS subscription like product. So we are seeing those kind of also for distribution of other value added services, value added products, which then become a segue for them to be distributed through that wallet.
Correct. So I completely agree with your point on how the M&A activity would really work in the case of regulated projects getting acquired. So we also have one of our custodians called Propine, which is getting acquired by Komainu. There's Ripple, which actually acquired a Swiss-based custodian for 250 million. So a lot of these deals are pretty ripe for and very lucrative for such big houses, right? Now, since M&A is still more Web 2, what are the kind of, say, traits or uh, you would like to see that is very nice and prevalent, rosy in Web 2, but one you want to get it to Web 3 because it's not as prevalent here?
So I I come from a Wall Street transaction background and I love structured products. So if you tell me, Pranav, this is a M&A opportunity which has a strike option, which has a call option or a put option built into it at a strike price with a collar built in for a ceiling and a floor, I would love such a deal, right? It's something if I go and tell my crypto bros, they would be like, what the fuck are you saying? Just don't bring it to us, right? So I think that evolution of the investment banking transaction advisory space has still not come here because we're more in the wild, wild west mode. Once we go from here to the regulated, more compliant, more structured frameworks and markets, and the user community increases, we'll see these structured products, we'll see these structured deals come here. And I think DeFi is amazing. Real world tokenization is going to be the second one because I always like to give the example if we want if we have Bitcoin today, and let's say somebody has $10,000 worth of Bitcoin, they can borrow against it in the next 10 minutes on with a computer and internet. But if I have $10,000 worth of Google or Apple stock right now, it would take a hell of a time to be able to borrow against that, even if I want 50-70% loan to value asset, right? Loan to asset value. So that kind of unlock, convenience, speed, cost is where I feel the blockchain will bring in a lot of structured products to the market. And whether it's payroll funding, which is payday funding, whether it's borrowing against real world assets that have been tokenized, we'll see many, many structured products being offered to the public. Like, built in hedges where a put or a call is sold for a covered call, covered puts. We don't do that anymore, right? But as a retail investor, if you told me, Pranav, you have $100,000 worth of Bitcoin, why don't you, at the Bitcoin price is $100,000, why don't you lock in and start selling calls for 10-20% of the money? I would take that 2% a month, right? So why not take it?
That's very interesting. What you said is making Web3 more accessible to Web2 users right now. I think that's a massive unlock that would happen and actually probably change the story of Web3 pretty much forever. So, do you have any timelines where you think that the user base is actually going to go more Web3? When do you think that would happen?
So one point we've been making in personally, I've been trying to tell all our founders is the industry misjudged the fact that Web3 a part of the reason is because the nomenclature Web3 meant that it's the blockchainized iteration of the internet, right? But it's actually not the case. Just like we tried to do tokenized social media or on chain social media, on chain marketplaces, on chain e commerce, on chain XYZ, even web hosting, it's not required. It's inefficient. It's not, I don't need security when I'm doing, I need payment security, but I don't need a secure network to do social media, right? I don't really care if 100 nodes looked at it or no nodes looked at it. So that is where I feel we will now bring adoption through defining a new set of transactions or user behavior which are for the blockchain. So I need not necessarily migrate everything from Web 2 to Web 3. It will be a set of Web 3 solutions which make my life easier. Like I gave you the real world tokenization example, the DeFi lending or on chain lending example. We see a lot of these payments in stablecoins is one, global remittances is one. We're seeing all of these as excellent use cases. Stable coins is an amazing use case, right? It's the easiest way to onboard a billion people to crypto is to start offering them the option to invest in a USD stablecoin or a Euro stablecoin or whatever currency stablecoin. And therefore, we're seeing that we believe that the Web3 adoption will come from a new set of solutions which are built, not necessarily what we've tried for the last 3 years, where we tried to bring Web 2 actions on chain. And similarly for AI, we'll see a new set of solutions where certain things were being done on the back end or being done by humans today are being done by the AI. So on chain will also have a large agentic AI uh, sort of need, because anything that is generative AI needs to have a blockchain to immutably, publicly verifiably timestamp their generation.
Right.
Otherwise, you'd have two AI fighting over who did it first. So a blockchain layer is a very nice public immutable way to build that sort of ledger.
Since we are talking about AI and how it's set to make our life easier in ways more than we can imagine, um, recall a conversation that Foundership is actually starting its own AI fund. So, would you like to tell the audience about what this fund is actually about and why did you specifically select AI as a sector? I know we spoke briefly about it, but what do you think will actually work in the AI space?
Yeah, so we're super bullish on AI, just like we are on blockchain, and we began that journey 3 years back. I think AI is also a horizontal theme. It's geography agnostic, it's sector agnostic, industry agnostic. It'll have the opportunity to permeate into anything and everything. With that, we want to be able to again attract young startups with first time, second time founders who are extremely passionate about building AI and can build tech ground up for the consumer. So we're looking at enterprise AI, consumer AI, we're looking at AI infra. There's a very strong thesis we have on what are called as specific LLMs or like subject LLMs, where a particular LLM is, say, a large language model like OpenAI or ChatGPT, DeepSeek, etc. But a smaller one which is super well trained for, say, university students who are studying in math, or for people who want to do fitness. So you will have these specific LLMs that end up getting curated. Like we were on a uh, VC demo day yesterday, and one of the startups had a AI model that can do R&D for peptides and molecules for the pharma industry. So they've fed them all the research that's coming out continuously on the pharma, all the past papers, and the AI is able to come up with new molecules, new peptides. Now it blew my mind, and I'm looking forward to speak to the founder in more detail. But those are the kind of applications where we want to back, and it need not have a blockchain angle, right? We're happy to do blockchain. So our thesis for the AI fund is simply to be having one more horizontal team where we attract founders. We want to begin with the Indian founders, either based in India or globally. We also want to have themes that are sector agnostic, geography agnostic, but are going to do one thing really well. So not a jack of all trades, which I think I don't want to beat OpenAI or compete with Gemini or DeepSeek or Claude, but something like a master of one, the best swimmer in the world who will beat you at a 100-meter race, the Usain Bolt of sprinting, right? Or the Michael Phelps of swimming. So we want to be able to build those startups from our portfolio, and therefore we're setting up a $10 million fund to be able to back about 60 startups in the next 3 years.
That's very interesting. So I think AI also needs to be more mature than just connecting an API to OpenAI and all of these things, which is something that we are currently seeing, right? Whenever we talk to a project, for all we know is just being connected backwards to a chatbot, and that's how they are giving solutions. But it's really crazy at the speed at which AI is evolving. Now, we've spoken a lot about what Pranav is as a VC, as an accelerator, but let's talk about what Pranav actually does apart from reviewing pitch decks, meeting 12 founders a day, and probably just probably trading a couple of trades on your phone. So, what does Pranav actually like to do in person?
So I love spending time with my family and friends. I've been a very avid traveler since my college days. Had the opportunity to backpack across Europe when I was studying there. Uh, Traveled several places. So our family, we have a young family. The three of us love traveling. We try and plan as many holidays abroad or around the world as we can. At the same time, I've been a Vipassana practitioner for about 20 odd years now. So I love the art of meditation. I think it keeps me grounded. It allows me to not get stressed or overreact or react too soon. More sort of, aware of what's happening around me. I think with the crypto never sleeps industry, it's super important that my meditation helps me sort of stay calm and keep my composure, not get stressed about a 30% fall in Bitcoin because Trump decided to add some tariffs to China. So those kind of situations is where I think I love it. We love doing game nights. We love playing cards, poker with our friends. So these are sort of if you've been in Dubai, Pranav loves doing a shisha session. So many of my friends have that, and sort of watching cricket. So these are the things I love doing in my spare time, and I think for me, I'm more social. I love spending time with friends and family, and that's pretty much me.
So now we get to the fun segment, which is the rapid fire round. And I'll be asking you a couple of questions and you'll have to answer in a word or two. So are you ready? So what's your Bitcoin prediction price by the end of 2025?
250K.
250K. Wow. That's the most optimistic price I've got.
Oh, wow.
So what layer of Web3 do you think is the most hyped right now?
L3, there's no layer L3, but like people have been like building layers on tops of layers on tops of layers. So I think L3s are the one. The L1s are the real ones.
What is the biggest myth about DAOs right now?
That they're decentralized.
Do you think real world assets is one of the places which can actually get the normies into the crypto world?
100%.
What's your biggest contrarian belief about Web3?
That we don't need anything except Bitcoin.
What is the most killer DApp of the next cycle? Do you think it's DeFi, gaming, infra, or probably something else?
AI.
What is the best retail use case for Web3?
I think real world assets, fractional ownership of real world assets.
Do you think AI is a ally or do you think it's a threat to Web3?
AI is an ally, 100%.
Do you think in our lifetime, our grandmas will ever be able to use Web3?
No.
And my last question, what is your preferred mode of investment? Do you think it's liquid OTC deals or early stage investments?
For me, it's early stage investments.
So thank you, Pranav, so much for coming to the podcast. It was absolutely a pleasure speaking with you and a lot of fun as well. For the audience, the social media links to Foundership will be given in the caption below. Please like, share, and subscribe to the Foundership channel. And thank you for tuning in to our XVC Tech podcast. I'll see you next week with another person on the couch. Till then, keep building, keep innovating. Thank you so much for tuning in. Goodbye.